Ever wondered how to pick the right stocks for your investment portfolio? It all starts with understanding your investment goals. You see, investing isn't a one-size-fits-all journey, it's a personal adventure tailored to your financial aspirations and life circumstances. Think of your investment goals as the destination on your financial roadmap. Are you aiming for short-term gains through active trading? Or perhaps you're looking to build long-term wealth for your retirement years? Each journey requires a different route, with varying levels of risk, time commitment, and potential returns. Short-term investment objectives typically involve buying and selling stocks within a few weeks or months, capitalizing on market volatility. On the other hand, long-term investment goals focus on steady growth over years or even decades, often involving dividend-paying stocks or index funds. Remember, a clear vision of your financial goals is the first step to successful investing. So, take some time to reflect on what you want your money to achieve for you. How much risk can you handle in your investments? This question sets the stage for our exploration of risk tolerance, a crucial factor in making sound investment decisions. Imagine risk tolerance as your financial comfort zone. It's the amount of volatility or ups and downs you can handle in your investment values without losing sleep. Risk tolerance isn't just about your mental peace, though, it's also about your financial situation. How much can you afford to lose without severely impacting your lifestyle or financial goals? Now here's the interesting part. Risk and potential returns have a seesaw relationship. Generally, higher risk investments have the potential for higher returns and vice versa. But remember, potential is the key word here. High risk also means a higher chance of losing your investment. In essence, understanding your risk tolerance is about balancing your desire for returns with your ability to handle potential losses. Knowing your risk tolerance helps you make investment choices that align with your comfort level. Ever wondered where to start when choosing stocks to invest in? A great starting point is understanding the different industries and sectors. Think of the market as a giant supermarket with each aisle representing a different industry. You've got your tech aisle, healthcare aisle, energy aisle, and so forth. Each industry behaves differently, has its own set of rules, and is impacted by various factors. So how do you pick the right aisle to shop in? Well, that's where economic trends come into play. For instance, during a technology boom, tech stocks might be the hot ticket. But during a healthcare crisis, pharmaceutical and healthcare stocks might take the lead. Understanding these patterns and how they impact different sectors can give you a leg up in selecting the right stocks. It's all about staying informed, keeping an eye on the big picture, and being able to adapt to changing market conditions. Remember, a well-rounded understanding of different industries can help you make informed investment decisions. What makes a company a good investment? A question that often pops up in the minds of beginner investors. And the answer lies in fundamental analysis. It's like peeling back the layers of an onion. But instead of tiers, we find financial metrics that help us understand a company's value. First, we have earnings. Think of it as the company's report card. It tells us how much profit the company is making. More profit tends to indicate a healthier company. Next up, revenue. It's the total income the company generates. Increasing revenue over time can be a promising sign that the company is growing. Lastly, debt. Too much debt can be a warning sign. It may mean the company is over-leveraged and could struggle to pay back what it owes. Just like in life, balance is key. A company with strong earnings, growing revenue, and manageable debt may be a good investment. Remember, understanding a company's financial health is crucial when choosing stocks to invest in. Ever felt lost while looking at a company's financial statements? It's a common feeling, but understanding these statements is crucial for investment decisions. Let's simplify it. Consider financial statements as a company's report card. You get three main reports: the income statement, balance sheet, and cash flow statement. The income statement shows the company's revenues and expenses, giving you the net profit or loss. It's like the company's score in a test, showing how well it performed in earning revenues and controlling expenses. Next, the balance sheet gives you a snapshot of the company's assets, liabilities, and shareholders' equity at a specific point in time. Think of it as the company's health checkup report. Lastly, the cash flow statement shows the ins and outs of cash in the company. It's similar to monitoring the company's diet, revealing whether it's cash-rich or cash-starved. With practice, you'll be able to extract valuable insights from these financial reports. What role does leadership play in a company's success? This question is fundamental when considering an investment. When we talk about leadership, we're not just talking about the CEO. We're looking at the entire management team. their experience, their track record, their vision for the company. Why is this important? Because a strong leadership team can navigate a company through both calm and turbulent waters. They make strategic decisions, manage resources, and steer the company towards its goals. Their qualifications and past performance can give us a glimpse into how they might handle future challenges. Consider the visionaries of our time, like Steve Jobs or Elon Musk. Their leadership has undeniably shaped the trajectory of their respective companies, Apple and Tesla. But remember, it's not just about star power. It's about consistency, strategic planning, and the ability to inspire teams towards a common goal. Strong leadership can be a key indicator of a company's potential for success. How does a company stand out from its competitors? This is a crucial question to ponder as an investor. A company's competitive positioning within its industry is a key determinant of its potential for success. Let's delve into this. You see, every company operates within a larger ecosystem of competitors, suppliers, and customers. The way a company differentiates itself within this ecosystem is its competitive positioning. This could be through a unique product, superior customer service, lower costs, or even a strong brand. For instance, a tech firm might shine through its groundbreaking innovations, while a clothing brand might win customers over with its sustainable manufacturing practices. Understanding these unique selling propositions can give you a sense of a company's competitive strength. Now, remember that competitive positioning isn't static. It evolves with market trends, customer preferences, and technological advancements. So it's important to keep an eye on how a company adapts to these changes. Understanding a company's competitive edge can help you predict its future growth. How do you know if a stock is overvalued or undervalued? This is where stock valuation metrics come into play. They are tools that investors use to compare a company's financials against its current share price, thus helping to determine if the stock is a good buy or not. One of the most commonly used metrics is the price-to-earnings, or PE ratio. It's calculated by dividing a company's current share price by its earnings per share, providing insight into how much investors are willing to pay for each dollar of a company's earnings. Another useful metric is the price-to-book, or PB ratio. This measures the market's valuation of a company relative to its book value. It's a great way to understand how much you'd be paying for a company's net assets. But remember, these are just tools. They can't predict future performance or account for all factors. Always look at a variety of metrics and consider the broader market conditions. Remember, proper stock valuation is key to avoid overpaying for a stock. Ever heard the saying, "Don't put all your eggs in one basket"? In the world of investing, this age-old wisdom is known as diversification. Diversification is the practice of spreading your investments across various assets to reduce exposure to any one particular investment. Imagine you've invested heavily in a single sector or stock. What happens if that sector takes a downturn or that company faces a scandal? Your entire portfolio could take a significant hit. But let's say you've spread your investments across different sectors, asset types, and even geographic locations. If one investment falls, others may rise, reducing the impact of the poor performer on your overall portfolio. It's like a safety net, catching you when a high-flying trapeze act goes awry. Diversification doesn't guarantee profits or protect against all losses, but it can help mitigate risks and smooth out potential returns. Remember, a well-diversified portfolio can help mitigate risks and smooth out potential returns. How do you stay updated with the ever-changing stock market? You might wonder. Well, it's all about staying informed and being proactive. In the world of investing, information is power. Whether it's breaking news, quarterly earnings reports, or a company's annual meeting, every piece of information can potentially impact your investments. There are numerous resources available to keep you in the know. Financial news outlets, investing podcasts, and even social media platforms can be excellent sources of timely and relevant information. Websites like Yahoo Finance, Bloomberg, and the Wall Street Journal provide comprehensive coverage of the market, while podcasts like The Motley Fool Money offer insightful analyses of recent trends. Furthermore, following the companies you've invested in is key. Stay updated with their press releases, quarterly earnings, and annual reports. This will give you a better understanding of their performance and future prospects. Remember, the stock market is dynamic and constantly evolving. Staying informed is crucial to make timely and informed investment decisions.